There are a lot of costs that go into buying a home outside of just the down payment and closing costs, and that's what we're going to cover today. Hey everyone, my name is Zach Pittman. I'm a loan officer here in the Carolinas, and I help professionals to purchase homes and investment properties. I myself have purchased homes, sold homes by myself, wholesaled. I've also managed, renovated homes through the Carolinas. So today I have a special guest for you. Her name is Camille Grimsley, and she's a North Carolina and South Carolina real estate agent. You can find her on Instagram. So Camille and I are both going to discuss the cost of buying a home. She's going to cover the upfront costs. I'm going to cover the closing costs. And we just felt like there was a lot of misinformation going on, and people really don't understand what it really costs to buy a home, because there's more than just the down payment, because you're going to have closing costs and what you're paying to the lawyers. You're also going to have upfront costs and things like inspections. So we're going to run through that. We're going to give everyone the best info that we can. If you have questions, make sure to drop those in the comments. And here's Camille to give you some tips on what the upfront costs are in real estate.
Money that's due throughout the transaction from the very beginning, I refer to as upfront costs. Now, the real estate transaction varies a bit from state to state, so I'm talking to North Carolina buyers. For North Carolina home buyers, your upfront costs are going to include your earnest money deposit and due diligence fee, as well as the cost of home inspections and the appraisal. In North Carolina, the earnest money deposit and the due diligence fee are amounts that are paid upfront as soon as your offer is accepted and you're under contract on your future home. In some other states, these may be referred to as a good faith deposit or an option fee. You give this money upfront to show the seller that you're serious about the transaction, that you have some skin in the game, and to compensate the seller for the time that they're taking the home off the market for you to do all of your inspections and due diligence on the property. You can give as much or as little earnest money and due diligence as you like, but in a competitive market like the one we're in now, of course, the more you give, the better. Again, there's no minimum amount or required amount that you have to give, but for estimation purposes, my professional recommendation is that you plan to give at least 1% of the purchase price of the home. You might be thinking, whoa, 1%, that's thousands of dollars. Yes, that is correct. But the great news about the earnest money deposit and the due diligence fee is that the amount that you give is actually going to be subtracted from how much you owe at closing. Once your offer has been accepted, you're under contract, and you've paid your earnest money deposit and your due diligence fee, now it's time for you to do inspections on the property. In addition to a general home inspection, you might want some supplemental inspections. For example, a termite inspection, a radon gas inspection, a chimney inspection, or an HVAC inspection to check out the heating and cooling system. You might also need a contractor to come out and evaluate a specific issue, and sometimes they will charge a diagnostic fee or a trip fee. You should set aside at least $600 to $800 for inspections. While you're handling inspections, your lender will also order an appraisal or evaluation of the property to be done. Your lender will likely need this to be paid for upfront, and you can expect an appraisal to cost about $500 to $900. So you can see that even before you get to the closing table, you've already invested a good bit of money into your future home. And that's why you want to make sure you have an awesome realtor like myself and a great loan officer like my friend Zach Pittman over at Rapid Mortgage on your team to protect your interests and your investment.
So Camille did a fantastic job of explaining the upfront costs that come with your home purchasing process. What I want to do is now go through what your closing costs are going to look like. So let's just take an example. And you can always go to Google and just search for closing cost calculator, and it will come and tell you, hey, here's the breakdown of everything in your closing costs. So let's take an example for a loan amount of $200,000. And let's say you qualify for a conventional loan, which gives you the ability to put down just 5%. All right, you want to do it over 30 years. You don't want your interest rate to change. So we'll do fixed rate. And let's just choose something here in Charlotte. So we'll enter a Charlotte zip code. And then when I calculate, it will go ahead and spit out all of the estimates for this property. Okay, so your estimated closing costs, including prepaid items and escrow for a 30-year fixed loan, is going to be $7,298. And if I scroll back up, it's also going to tell you your down payment amount is $10,000, which means the loan that you'll get is $190,000. So you will have the $10,000 plus the $7,298 in closing costs in order to acquire this home, but also keeping in mind what Camille talked about, which is your upfront costs. So all that together is how much it will cost you to buy a $200,000 home, in this case, in Charlotte, North Carolina. And that's by putting down 5%. Okay, so this is why taking into account all the fees and how much money you really need to purchase a home. There are ways around it. There's down payment assistance. There's other programs you can go into, but this is the most common, a conventional loan at a fixed rate. This is the most common that I typically see. So when I go down to closing cost details, the first thing here is points and lender fees. So points, if you click on it, it will give you an explanation of what that is. Essentially, to give you the quick rundown, actually, let me leave this up in case you want to read it. Essentially, what you're doing is points. You can buy points. In doing so, it will lower your interest rate. People think that paying points to lower an interest rate is really going to save them money. That's not always the case. You really need to think about what you're doing and why you're doing it, because here, this is the Bank of America site, but it's saying you can buy points for $1,725. Well, we need to know how much is that lowering my rate, and then how much is that saving me per month on my mortgage. So let's say you're paying $1,700, but it only saves you $10 a month off of your mortgage. It would take you 170 months to get that money back. That's 14 years. So if you're not staying in the house 14 years, does it really make sense to go ahead and pay the $1,725 up front? Maybe, maybe not. It's up to you. So anytime you are talking to a lender, you need to get an answer on whether or not they are charging you for points, and you need to know how much it is and what's the change in your interest rate. Now, after that, you have a lender origination fee. This is the fee that the lender charges to process your loan. All right, next we've got your other third-party fees. You may have already paid for your appraisal, but we're going to usually include it on your closing costs. If you've already paid for it, it'll come off. So this is going to be for your appraisal. You're going to pay for your credit report. You're going to pay a tax service fee. This is to make sure the taxes have been paid on the house that you're buying. You're going to pay a flood certification fee. This is to determine the flood zone, along with the ability to pay for the life of the loan flood monitoring, because sometimes flood zones will change. You have your title Alta 9 endorsement. So here it's doing a check on any encroachments on your property, like is there a road that's running through your property. You got your title Alta 8.1 endorsement. That's going to make sure there's no liens against your property. You have your title closing escrow fee. This is the amount you'll pay to the title company or your lawyer for processing all of the paperwork. You have lender's title insurance. So here's where things get tricky. You are paying the insurance for the lender. So you pay that amount, but it's not insurance for you. It's insurance against the house for your lender. It's insurance for your lender, because someone can come and say, hey, this is really my house. This is not your house. I have the rights to it. So this is ensuring the lender that, hey, we're not writing a loan on a property to where we don't, someone can come challenge the title. So they need to be insured against that. You can also buy your own owner's title insurance as well. And that's only $25. So that will insure you in case someone comes and tries to challenge the title on the home. And then you have $140 to record the mortgage with the county. All right, from there, as we move on, we get down to estimated prepaid interest, taxes, insurance. So you got two charges, prepaid interest and $264. What this is, when you close on the house, you're not going to make a mortgage payment until the next month after. So let's say you close, let's say the beginning, what's the day? January 20th. Let's say you close like the beginning of February. You won't make that first payment until the 1st of April. So you have some time in between when you close and when you make your first mortgage payment. The prepaid interest will change based on the length of time that you are holding your mortgage before you make your first payment. So it will change. It says estimated 15 days because it depends when you buy your house in the month. Is it before or after the middle of the month? And then you're also going to have your homeowner's insurance for the year. So you're going to have those payments. And then here you will have your estimated escrow account funds where you have your homeowner's insurance again in that period of time from closing to until your first mortgage payment. And then your property taxes again from the time you close until your first payment, because the rest of it, your insurance and taxes are going to be tied in to your monthly payment. But in the middle, you're going to go ahead and pay those up front until your mortgage starts. So I hope you got some value out of this video from Camille and I. If you need a realtor in the Charlotte area, definitely hit her up. I'll list all of her information down in the description. If you need a lender or would like to talk through a lot of the numbers that come with closing and acquiring a loan, definitely give me a shout. Definitely leave any questions in the comments, like and subscribe, and I'll see all of you in the next video.